This is your LMAX exchange technical update for Friday, May 19th, 2017. Euro dollar. So the euro continues to show signs of basing out since the market put in an inverse head and shoulders formation earlier this year. The break above 108.75, which had been the neckline, ultimately projects medium-term upside up towards and above 114, which coincides with longer-term range resistance. On a short-term basis, the recent break that we saw above 110.20, which was the previous 2017 high, opens the next measured move upside extension towards the 112 area. So 112 to 114 is that area where the euro looks to be headed over the coming sessions, and any setback should be very well supported. Ultimately, only a break all the way back down below this previous higher low at 108.40 would take the immediate pressure off the top side. Sterling dollar. So cable continues to consolidate just off that previous resistance at 127.75, but the breakout is a significant one as the market is now pushing up to 2017 highs, most recently pushing above 130, and this sets the stage for this next major upside extension in this market towards a measured move extension at 135. The 135 area, that extension follows the period of roughly the same consolidation size that we had seen between the 120 to 127 area back earlier this year and in late 2016 as the market consolidated off the plus 30-year low at 118.40. And so again, this breakout now projects a medium-term measured move upside extension towards 135. If we do see any setbacks, they're viewed as corrective, and the market should be supported into the 125 area in favor of a higher low, with only a break back below 123.60 to compromise the newly adopted bullish outlook for sterling dollar. Dollar yen. So clearly dollar yen is pressured back to the downside after the market stalled out at 114.37 several days back, and well ahead of some key resistance at 115.60, which was previous range resistance from earlier this year. This puts the pressure back on the downside and the focus on a retest of the 2017 low that was seen back in April just ahead of 108, with a break below that level to accelerate declines potentially down towards the 105 area. At this point, look for any rallies to be very well capped, with only a break back above 114.37 to take the immediate pressure off the downside. Euro Swiss. So Euro Swiss saw an impressive run of late, with the market trading all the way up to just shy of 110, that critical psychological barrier. Inability to establish above 110 is suggestive that the market will once again roll over and does keep the longer term pressure on the downside, with the possibility for a resumption of declines back down towards some recent critical support towards 106. At this point, it would take a break back above 110 to force a shift in the structure, and again, while inability to do so will keep the pressure on the downside. If we do see a break below some recent support which comes in around the 107.80 area, that would really accelerate declines and expose a retest of the 2017 lows. Aussie dollar. So Aussie continues to show signs of topping out, and although we've seen a bounce over the past several sessions, it's viewed as a corrective bounce where the market is looking for that next lower top in continuation of this move to the downside for an eventual break back down towards medium-term support, which comes in by December 2016 lows at 71.60. At this point, only back above 76.11, the high that we saw back on the 17th of April, would compromise the bearish outlook. Dollar CAD. So dollar CAD setbacks are just viewed as corrective at this point, and although we could still see a little bit more of a corrective decline, ultimately this is a market that's looking for a higher low in favor of a continuation of gains through the recent highs from 2017, just shy of 138, and towards that next key psychological barrier at 140 further up, only back below a low that was seen back on the 13th of April around 132.20 would take the immediate pressure off the top side. Kiwi dollar. So Kiwi continues to show signs of topping out in 2017 following the market stalling out back in 2016. At this point, there's deeper setbacks favored on a break below the recent 2017 low at 68.15 about, which would expose a fresh drop down towards the 65 area. Any rally should continue to be very well capped, with only a break back above the high from the 21st of March around 70.90 to compromise the bearish outlook. SPX 500. So the S&P 500 has pulled back quite a bit from recent record highs, but at this point it would take a break below 23.22, the low from the 27th of March, to take the immediate pressure off the top side, or the medium-term pressure off the top side, and suggest a more significant shift in the structure. Until then, this setback is viewed as just a minor correction ahead of what could be a continuation of gains to fresh record highs and beyond, up towards the next measured move, just shy of 2,500 at 24.80. But again, If the market does continue lower and breaks down below 23.22, that would force a significant shift in the structure. Gold. So gold continues to show signs of basing out off that 2016 low, putting in a series of higher lows and higher highs. Most recently, the market has been supported down ahead of 1200 in the 1215 area, and this is potentially that next higher low, which will be confirmed on a push to fresh 2017 highs beyond 1295, exposing the 2016 peak at 1375 further up. Only back below this recent low at 1215 would compromise the bullish outlook for gold.